Hi everyone, my name is Emily Merton and I am a graduate associate with Prevention and Wellness. And today for Wellness Wednesday, we're going to be talking about financial wellness and stocks. So what is financial wellness? You can see over here that it is in green on our dimension of wellness, and financial wellness is processing the skills and knowledge on financial matters necessary to confidently take effective action that best fulfills an individual's personal, family, and global community goals. And this is from the National Financial Educators Council. So to sum that up, it's basically having the knowledge and skills to effectively manage your personal finances in the way that benefits you best all around. So let's talk about stocks. What are stocks? Stocks are a type of security that gives stockholders, which would be the person who purchased the stock, a share of ownership in a company. Stocks are also called equities, and this is found on investor.gov. So stocks are part of, you can buy a share of a company, which is like a piece of a company. And when you do this, you can invest in that company and you can make money back potentially. So how can you learn more about stocks? I just got into investing recently within the past 2 years or so, and I went about starting to invest by doing my research on my own. It kind of popped up in a TikTok that I watched. I was like, oh my goodness, this person invested and has made so much money off of it. I personally didn't want to do it as risky as that person had, but I knew that I wanted to get into investing. And so I looked up a lot of different websites on like what stocks are, how to invest, what's the best way to invest. And then I reached out to a financial advisor. Luckily, my grandparents also invest, so I asked them if their financial advisor would be willing to sit down with me and talk to me about how to invest, what's the best way to go about it. And I also realized that there are a lot of resources on campus that can help you, help financially advise you in a sense of if you work in or if you're a student within the business center, or if you have connections on campus of people who even your professors might invest and might be able to give you some helping tips. So just reach out to people who you think might be investing in companies, and it's not rude to say, hey, do you invest? Can you give me some tips on the best way to do so? And start small. That was the biggest thing that I learned. A lot of financial advisors will suggest you not invest individually on your own into companies. So basically, that's when you would buy stock in a specific company, and that's kind of risky if you're a beginner investor. So I personally didn't know how the stock market worked fully by just hearing what people were saying. I needed to kind of dip my toes in the water a little bit. So I invested a small portion of my financial assets into Apple, which is a very trustworthy investment because Apple has shown growth, continuous growth over a long period of time. So I just invested a little bit into that just to see how it worked, how I lost money, gained money, what happened over a period of time, and just kind of really understand what was happening with my money. And then look into companies that are for beginners. So another way that you can learn about stocks or invest your money is to look into bigger companies that help beginners invest money without you having to really know everything about it, and it has professionals work with your money. So we'll get into more with that in the next few slides. So 6 tips for investing in the stock market. Invest with companies is a big tip that I heard on a lot of different websites, and a tip that I personally heard when I was looking into it. So there are companies like Fidelity and Marcus by Goldman Sachs. These 2 companies are very well known for investing money, and what they do is they have professionals that can manage your money and determine where your money needs to be moved when investing in the stock market. And you really need to watch out for management fees and minimum investments when you're looking at investing with companies. So sometimes if you decide, oh, I want to go with this company, they might have the professionals who are managing your money, they might take a fee out of what your earnings are when you do decide to take money out of the account. So if they have that, the fees can get pretty steep or they can be none. So check in to see, make sure that there aren't many fees when you're investing your money. And then minimums are a big deal. So say you have $20 to invest, or say you have $2,000 to invest, you need to make sure that the company that you're investing with is okay with a minimum. So like Fidelity, for example, has a $0 minimum. So you can invest $1 tomorrow and their company would do with that $1 what they could. Or if you invested with a different company, sometimes they have $50,000 minimums, which a lot of college students might not be able to swing that. Start now is the next tip. So starting now is a tip that I've heard all around the board is invest your money now because it typically just grows over time. You can't expect your money to grow, which is the other tip. Be prepared for a downturn and know the risk. But starting now helps your money grow over a longer length of time. And avoid deep investment in individual stocks as a beginner. So like I said with Apple, and I've also invested in a few other like smaller companies that I did a very small portion, gave a very small portion of stock to, or I possess a small portion of stock in, and avoid putting a lot of your money into those individual companies because that's just very risky for beginners in the stock market because you don't exactly know how the stock market typically fluctuates and what's going on and fully grasp that. So they do suggest to invest with companies, professionals do. And be prepared for a downturn and know the risk. These are two very big things that you're going to hear everywhere. The stock market is not trustworthy in a sense of, oh, your money is always going to go up. That is not the truth. You might not always come out at the end of the day with making more money. And so you don't usually check it every day. That's not typically what people suggest because you can be very discouraged when you do that. But be prepared to lose some money along the way and stay committed to your long-term portfolio. So when you do invest and you invest within different companies or using different companies to invest your money, stay in it for the long term. So you don't want to invest this year expecting to pull out money next year because like I said before, there will be downturns, there will be risks. The longer your money stays in the stock market, the likelihood it is to increase.